Okay, so good morning, everyone. Officially starting our weekly webinar today, 10 a.m. on Thursday. Thank you for joining us once again for our sort of brief, high-level 30-minute update. And it's great that so many people choose to put this in their diary and tune in. I'm sure maybe with a cup of coffee or a cup of tea in hand, and we're getting a bit of information of what's happening in the market, a few educational tips. And we certainly appreciate you taking the time with us today. So we are continuing our look at Learn, Earn, Own, and today we're focusing on the own part, which is the owning assets. And there's been some interesting things in the news just recently, which will play into that. So if there does happen to be some new ones on, I think there are a couple of new ones on today. For those that don't know me personally, David Johnson, CEO of Leo Crowdfunding. We're a crowdfunding platform. And my co-host is Mr. John Gorey. Good morning, John.
Good morning. Good morning. Slightly different background today. We can cover it or not.
Yeah. That may be relevant when we come to some things happening in the world of assets. So, property market update. I've chosen two things today, John, just for a brief discussion on. First of all, an interesting development, which I think is very positive overall. So, the government is putting out this intention that particularly young people, but I suppose first-time buyers, they're going to offer a long-term fixed mortgage rate of up to 95% of the home value. If this does come in, I think it's very positive for the market and will certainly help sales and certainly help first-time buyers get on the market.
You could argue that the US has done this since the 30s, so therefore there's maybe an example and people can look to it and figure out what works, what doesn't work. There's some positives, some negatives. I do find it interesting. There's an underlying assumption that if you're of a certain age, you're somehow entitled to be an owner rather than get on with it. Choose your choices in life, but why should the government decide for you that you have a right to have ownership of a house? Will we do ownership of a car? We'll do a 95% loan program for cars, and then we'll get to stamps and other sort of hobbies. So there is this in the US definitely has this very strong sense of, somehow ownership is a right and the government can facilitate that. Now, there's a lot of positive economics on the backside of, having a stable housing market and all the rest of it, but it is like, where do you draw the lines? Health, wellness, and home ownership?
No, that's a very interesting point. And I've heard you in the past talk about how, if we even take just the UK, home ownership is a relatively new norm, that it wasn't that long ago in the UK that actually the majority of the population didn't own a home, they just rented.
Yeah, when the Queen became the Queen, in 53, 54, whenever it was, 70% of the country were renting. And that was normal. That it was not just that one generation. Mm-hmm. It was a little bit banking reform that spiked up ownership. It was a little bit women working and lenders realizing that women should be able to get a loan in their own name. And it was a little bit Thatcher selling off housing because the government was bankrupt. Technically, in 1976, the UK went bankrupt. So they unloaded a bunch of assets, which included council housing. You could argue the government only became involved in council housing after 1919 because of the Germans in World War I and then the Germans in World War II. So the idea that councils provide housing is a German thing, so to speak, or indirect because of the Germans.
Yeah. No, interesting. So if this does come in, 95% long-term fixed rate mortgages, I think that will certainly have a positive impact on the market. Now, the other news item I've chosen, which is almost the other extreme, in the sense of when the government steps in and starts to put in measures, if you like, rather than just the market being the market. And this kind of made me smile, but I'm sure it's serious for those involved. But there was a protest march, I'm not sure if you saw this, a protest march in Wales where protesters marched 20 miles as part of their protest to complain that house prices were too high in the area. A bit of a dream if you actually own a property and you're a landlord or you're a property investor, that in the middle of COVID, we actually have people walking to protest that house prices are too high. obviously to do with a second home and being a very popular resort. But it's interesting, the two extremes, the government helping people buy houses on one hand, and then the other hand, with people complaining that house prices are too high.
It's been a long-term problem, and it isn't just holiday homes in resort areas. Many people would argue house prices are too high in London, but it's an open market. If you want to lower the prices, you have to increase the supply. No one votes for increasing the supply. If these holiday locations just flattened a bunch of houses and built a few skyscrapers with flats, that would help rebalance things, but it would in effect take away the character of the area, which is maybe something that should be protected. So there isn't actually a happy answer to these questions.
Yeah, absolutely. That's exactly it. And there's lots of factors, and there's not one simple analysis of a market. I just found this like, if you were to ask 100 people in the street what's happening to UK house prices because of COVID, probably anyone not involved in property would probably immediately say, oh, there's going to be a crash, there's going to be problems, there's going to be challenges. And yet there are pockets where there are individual situations where actually house prices are exceptionally high and continue to rise, which is interesting. So by way of update, I'm delighted. I think one of the reasons I'm in such a good mood today, John, is that we have another project that has been successfully funded on our platform. So the West Buildings high yield HMO conversion in Worthing has successfully reached its maximum target. So it had a minimum of 100K, and it reached that, I think from memory, on Monday might have been. And now through to the last day of the raise yesterday, it actually reached its maximum target, 142,538. So thanks to all the investors who chose to invest in this. I can see that was their number who attend this webinar regularly. But it's great to get another deal done, John. And this is certainly was a strong proposition, albeit structure slightly different, being a longer term investment, but certainly great that we have had another successful raise.
Well, it has to be a different proposition, because this is a classic BMV HMO, buy and hold, recycle your cash deal. This is sort of the bread and butter of the sector, where people want to buy for a long-term hold for rental income. And that's what this project was all about.
Yeah, very much so. So there'll be some obviously updates on the project for all the investors, and we'll obviously get your timeline as to what's happening with this going forward. So again, really good news, delighted, and many more down the line is the plan.
Good.
So education then, let's get straight into today. The mission that we have as a company, help investors learn while they earn how to own property assets by leveraging the power of the crowd. And we've spent the last 3 weeks just looking at learn, earn, and own. And today is very much on the own, the O for ownership. And really that's what people get involved, I suppose, in property primarily for, is to own the assets. Some maybe just for short-term income, but I think primarily, John, in terms of just summarizing the topic today, owning the asset of property is what a lot of people want to do for a whole bunch of reasons that we'll look at, but really, yeah, asset ownership is where wealth is created.
Particularly if you hold it for the long term. And this is, learn and earn has been used a few times with people, but I like to joke that the way that's normally structured is you give your money to a guru who then gives you a minimal interest rate with the privilege of learning, where here you're actually in the deal, you're owning part of the deal, you're no longer just, quote, a student.
Yeah. Okay, so let's just have a quick sort of summary of the market. Again, neither John or myself are financial advisors, or not in any way trying to give financial advice or tell anyone where they should invest their money. But if we were just to look at the broad brush of owning assets in the world today, the wee diagram there kind of gives you some of the main segments. Property, of course, we'll talk about. There's commodities, obviously metals and energy, agriculture. You've got bonds, corporate bonds, government bonds, cash, of course, equities. So they're kind of the main ones. There are some other sort of different segments, but I think the interesting one, John, just briefly before we move on, is a lot of people recently have been looking to Bitcoin as an asset to invest in. But I heard just this morning, Brenda in the office was indicating that the FCA have seemed to have an opinion on retail investors, restricted investors buying Bitcoin, and that could bring a few changes to owning assets in the market.
Well, I think it's rich to call Bitcoin an asset. We could have a market for umbrellas, and if enough people want umbrellas and other people can't make them fast enough, then the price will go up. But does that make it an investable asset, or is it just sort of scarcity? When I buy a Diet Coke on a hot, sunny bicycle ride in Richmond Park, I'm going to pay over £2. If I go to a NASDAQ, I can buy something that's 4 times larger for half a pound, or maybe a little bit more. So, is that an investable asset?
Yeah, I'd probably disagree with you a little bit on that, because certainly the banks and financial institutions, etc., are all clearly class Bitcoin as an asset, and I don't think there's any question that a lot of banks were moving to be more Bitcoin friendly as a viable way of perhaps doing business in the future. Your Bitcoin machines that are dotted around various countries and things like that. I think it's a viable currency, but I'm not saying it's where it needs to be. But
no, it isn't. No, it isn't. No. Don't kid yourself. Well, those ATMs are owned by individuals like you and I. They're not owned by banks. The banks are moving towards blockchain for ease of transaction. They're not generally saying that they believe in Bitcoin, and they're willing to trade it as a derivative if other people want to trade it. But tulip bulbs were an asset, right?
Yeah, well, so it depends how you define asset, but the reality is you can walk into shops all over the world today, buy your coffee, buy your food, buy your goods through Bitcoin. So it's a currency. It is absolutely a currency.
No, it isn't. No, it's just a transfer. I could walk in with my iPhone and buy stuff all over the world today. Does that make an iPhone a currency?
Well, it makes it a currency of transaction. But anyway, here we digress. So in terms of assets, then, what's important with assets is diversification by asset class makes sense. So don't put all or it'd be a good policy not to put all your funds into one of the segments. But also, I think, John, it makes sense to be geographically diversified. Don't just invest in one country, one economy. It probably makes sense to have, if the US economy is struggling, but you've got some of your assets in maybe Africa or Europe, then you're maybe sort of hedging your risk a little bit. And then there is this negative correlation where certainly some asset classes going up almost means by definition others are going to go down, and so you have this sort of balancing. So any sort of comments on?
So the U.S. tobacco industry made famous that if you repeat a lie enough times, it becomes a fact. And there's even been academic studies, professors, and all the rest. And Donald Trump is the latest manifestation. So this idea that some of these things are important in the right context. So if you're geographically diversified, that isn't necessarily a good thing. In fact, it might be a sign of excessive risk. If all your bills are in one currency, you have no intention of moving, you need income in the future or capital growth in the future, whatever, having it in other currencies subject to political risk and currency risk could actually really work strongly against you. So you buy a property in the US, it goes up by 10%, the British pound falls by 12%, you're at -2. And did you need to take that risk? So in the right context, maybe some of this makes sense, but if people were to overthink it, they're missing the reality of where do you live, what do you do, what do you need to fund in the future, what do you need to fund in the short term? Supply demand locally where you might actually have competitive advantage because you actually can go around and take a look. That's, I think, where people should focus, and less on this smooth it all out so it looks like oatmeal and it's all blended together.
Yeah, no, that's interesting. I think the key word you used there was context, and everyone's individual situations maybe a little bit different, but certainly these are things that people should at least think through as part of their decisions of where they want to invest is probably a good way of putting it.
My concern is because there's actually roughly 17 asset classes that most financial firms have recognized. And if you're trying to master 17 different things and then you overlay politics and overlay country and overlay currency, all of a sudden it's like you're doing your head in. Maybe Warren Buffett and a few others who are very wealthy would say, focus on one or two things in your basket and get really good at it. You bring competitive advantage to the table, and you don't get the effect of being dragged down by the average.
Yeah. No, that's a fair one. And I would always argue, and have always argued when I've been dealing with clients, is that most, not all, but most high net worth people, your multimillionaires, your multi-billionaires, most of them in the world will have property somewhere in their asset mix. So it's certainly very much a core element of someone's asset classes. If they choose to focus on a couple other areas, that makes sense. But certainly the vast majority of people, have property as a core part of their asset class. Which brings us on nicely to why property as an asset class. So I'll run down maybe just the first one, John, and I'll let you come in with your sort of high level thoughts. One thing I like about property is it's a tangible asset. You can talk about stocks and shares. You can talk about all different types. We could discuss Bitcoin, and this is relevant when it comes to this. There's something about being able to, actually see your asset, to actually walk through your asset, to actually, feel the brick of your asset, and therefore it's tangible. And sometimes that's obvious, but can be overlooked when it comes to property investment, as people are looking for, big returns and quick returns and things like that sometimes in other areas. Property is tangible. And I think that gives it a really good, solid sort of start as an asset class, John.
There's all kinds of ways to hear that. And one of the nice things is it has substance, so you know what you're dealing with, but it still could have lots of nuances and detail, different types of property and things. So I'm going to come back to this theme that it allows you to get good at something. And I would say residential is actually where many people started when they invest in property, because they've grown up living in a property. They've grown up living somewhere. And other than the people maybe spent their whole life on the street, they understand what it should look like, how it should function, what people tend to want. They evaluate it, they can build from that knowledge base. So it's the easiest jumping off point of the major asset classes. In the UK, just as a statistic, the property sector, and I believe this is just the residential property sector, is the biggest asset class, bigger than the stock market, bigger than bonds, bigger than commercial real estate. So it's also a big asset class, which allows you to get in and get out and not sort of move the whole market.
Yeah. Okay. Again, just remind people, I'm very happy to have comments made on the Q&A. I can see from the attendee list, we've got a lot of good professional people in property and indeed other aspects of business. So yeah, by all means, if you've got an opinion on this, it's one of these topics that definitely people have opinions. By all means, throw something in. We can add it into the mix. So inflation, John, just to explain why property has an element of inflation protection. I think that's one, again, people don't normally think much about.
So inflation, one definition is that your currency or your capital buys less next year than it did this year. And that's by design. The Bank of England, the US Fed, other countries, they have a targeted inflation rate, say, of 2%. So every year, your currency, your asset should be worth 2% less measured in the currency. Well, real estate in the UK, real estate in the US, real estate in many other countries is driven by the number of people that need housing and their ability to service the rent or service the loan. So classically, maybe it's healthy to be around 30% of your gross income, or maybe your net income, depends how you want to use the metric, goes to paying for your housing. So if someone is in a job, they tend to expect a raise. Part of that is why we have this inflation target. Every year we can give you a little bit of a raise, make you feel good like you're getting more, but frankly, we're just paying you what we paid you last year, given the buying power. Well, if every year you're going to get a raise and maybe you're moving up in your career, that means you can afford more and more house and still keep at that 30%. So whether it's rent or whether it's house prices, assuming there are people who want to live in the area that have a job, and as they progress through their career, as they progress through life, and they tend to have more buying power as they go forward, that means they can afford to pay a bit more for the house. So they actually start paying a bit more for the same house. And subsequent transactions, well, it's the same house, it's the same number of bedrooms, but it'll be more valuable to the next buyer because they're still only spending that third. So from a rental point of view or from a house asset value, it is relatively correlates to inflation in a reasonable sense. So it's a good long-term asset. Your income and your asset value will go up with inflation, just not exactly mirroring, but very close.
Okay, very good. Thank you. Thank you for that. So diversification opportunities. I think property, again, one of the advantages, one of the reasons I like it so much is that you do have the opportunity to invest in different types of property. So you can go from a buy to let, but within that, there's different segments. Is it a buy and hold for a long term? Is it involved in doing up property and adding value, getting planning and creating more value? Or is it dealing in commercial? And again, within commercial is all different segments. So you can even diversify your assets within property, which helps kind of spread that risk and mitigate the risk, which again, some other asset classes don't do that.
You can diversify within the street, owning different properties on the street or in the neighborhood or in the city or across cities. I'm a little bit negative on diversification. If you get too far out of your core patch, you lose your understanding and competitive advantage. You lose your ability to get a plumber to come around because you have so many properties. They're happy to always take your call. So I wouldn't overdo this diversification when it comes to managing the assets. If you can at least geographically concentrate them, you might actually have a competitive advantage and get a better return because you're focusing.
Yeah, okay, yeah, that makes sense. So on the compounding side, and I haven't actually done this for many, many years, but when I was doing property training years ago, I used to always use the example of the doubling and the compounding of the penny. And I'm sure most of you have already come across that, but if you take a penny, double it every day for 30 days, it turns into, from memory, over 5 million. Such as the power of that compounding effect. And that's really one of the key drivers to being involved in owning property assets, is that you can potentially get into this type of compounding. And then linked to that to an extent is leverage, John, where someone had 100% of cash to buy one property, perhaps buy 4 properties and put the deposit and borrow, and then you're leveraging your money, and obviously you're getting the asset growth on 4 properties, not just on one. So again, I'm sure you've come across these a lot in your time.
Yeah, I have, and the only reason you can actually leverage them is because it's such a safe asset class for banks to lend on. It's one of the lowest risk asset classes for a bank. If the LTVs are kept at a reasonable level, the default rate is actually quite small at those levels.
Yeah. Now, one of the barriers sometimes to property, and one of the biggest objections you hear from people is, oh, I would love to own a property, but I just don't have enough money for a deposit, or I don't have enough money to buy the property. So at some level, there are people who think they're precluded from getting into property as an asset class because they think they have to have enough money themselves to put down a deposit, then perhaps aren't confident that they have the ability to manage a buy to let with everything that goes with it. Maybe they just don't want the hassle of managing a buy to let or getting involved in property. So I think entry level for property is one of those things that has probably changed over the years, but certainly would be a barrier to a lot of people getting into this asset class.
Okay. Do you have an answer for that?
Well, I have an answer, but any comments on that before we get to the answer? I mean,
it has been a big hurdle. In fact, you see this with people who emotionally they know they want to be investors, so they take a course because they're professionals. They've been through universities or been through whatever schooling. They're used to listening to teachers, so they sign up for a course. and they buy a few more courses. It's a big topic, and pretty soon they spend 20 or 30,000 pounds on courses, and they're nervous about getting started, but also the deposit for a house in London would be much higher than that amount. So this idea of, can we lower the barrier to entry? Can we allow people to get started for smaller sums that they can afford? That's an interesting question.
Yeah, exactly, which does lead us nicely into the reason I do what I do, being CEO of a property crowdfunding platform. I think this is a really, really, really nice way to allow people into owning property assets. And property crowdfunding allows people to literally invest in property assets. They buy shares in special purpose vehicles, or SPVs as we call them, that obviously do the transaction and own the asset. And it's a really exciting way, and potentially a very rewarding way for people to start to build up their own personal assets in property. I've listed there just some of the main drivers. I mean, regulation and compliance, I think, is a huge driver for this. You certainly, people don't want to be involved in investing in schemes or any asset class that's going to find that they put their money into something that turns out to be not what they thought it was, and the money's gone. There's been plenty of horror stories of people who've invested even in property deals, overseas properties in the past, and their money turns out to be gone, unfortunately. So within property crowdfunding, it's not to say deals won't go wrong, John, in some cases, but in terms of the environment we operate in, there is regulation and compliance that must be adhered to. I know that's one of you're one of the champions of trying to clean up the industry and ensure that people do things in a proper way.
So crowdfunding deals do go wrong. It's definitely happened. I have invested in at least one that 100% loss. It was a planning opportunity. I knew that going in, that there was risk, and that's exactly what happened. I've invested in others that worked out. So that's when diversification makes sense. Spread it around a few deals rather than bet on one deal. The second one where it's vetted, I want everybody to really be clear about this. It is not vetted to the level where it's a safe deal. You can definitely lose money even on a platform. The point of being vetting is it's almost like an FAQ process. Here are the frequently asked questions and here are the answers. So the platform will ask a bunch of questions, which will force out a bunch of answers so that the offer document has most of the questions people are probably going to ask, and the explanations or the information is presented in a way that will tick all the things you would normally think of. If there's something missing, you then have the forum where you can actually ask your question there. Other people see the question, maybe build on it, and the people doing the raise will provide an answer. Then you have to make your own decision. You are definitely responsible for being an adult and making your own decision. There are no guarantee deals. And even when some of these peer-to-peer platforms say they've never had a deal go bad yet. Well, that's because they haven't been around very long.
Yeah, no, that's a fair comment. And just to add to that, the vetting of the deal is not vetting it as a good investment or a bad investment. The vetting of the deal is just confirming that what the fundraiser is claiming about the opportunity checks out. And what it means specifically, that if someone brings you a deal, well, one of the first questions is, well, do they actually own the asset? So as a platform, we'll confirm that they can prove they actually own the asset. Look at the purchase agreement. If it's a deal where perhaps they only have an option on it, then we obviously want to look at that and make sure that that's true. Where they claim a GDV figure, then we will obviously ask them to confirm independent GDV figures from a local estate agent or valuation, etc. So it's kind of that initial check just to confirm that what's been presented is accurate, but it's not vetting the deal and saying it's a good or a bad deal. That is up to the individual investor for sure.
Right. Right.
So the diversification.
A real quick example. There was a deal being sent around, however that happens, and I did receive a copy of it. The information looked reasonable. Whether the deal was going to turn out profitable or not, hard to say, but it looked like it might. There's nothing wrong with it on paper, other than the FCA confirmed it was a legal act to share the information. So at least on a crowdfunding platform, you know that the information being shared is being shared in a way that the FCA feels is appropriate. So everything you see isn't correct. I've seen some websites from companies that used to be FCA authorized, who now think they're being compliant but not authorized. Well, I have strong suspicions they're getting bad information and that they're not compliant.
Yeah. Yep. Okay. Diversification is important. I think it's one of the nice things. You've got a crowd of people, and they can choose to invest, small amount of funds or whatever funds they feel is appropriate, but into multiple deals. So you do get this diversification of opportunity. It could be a planning gain. It could be a ordinary development, vanilla development as we call it, or it could be a more long-term buy-to-let sort of hold strategy. But you can choose to actually not only invest in multiple deals within each sector, but invest in multiple sectors. And that's a very powerful opportunity, I think, that crowdfunding platforms allow. The crowd validation means that you've got multiple people who are looking at an individual deal. We all come from their own walks of life, their own background. You might have someone who's an accountant, someone who's already maybe a developer in the past. So when they have a look at the numbers and get involved in the forum and ask questions and clarify things, then that clarification and that, if you like, crowd validation benefits all the potential investors. And that's so we have had accountants invest, we've had lawyers investing, so they all bring their unique due diligence requirements to the table, and that's a huge benefit of property crowdfunding. So literally the crowd can do a due diligence, John, to a level that probably any one individual couldn't do themselves.
So as an example, I am not made up in a way that makes sense for running HMOs. I don't do the touchy-feely particularly well. I'm a little bit direct and maybe wouldn't be the best person for hotels or other things. But by crowdfunding, I can invest in someone else's HMO. I can get their special skills of running HMOs, and I can therefore have an exposure in that sector. Same with when I fund planning opportunities. I don't want to be a planner. I'd rather back someone who's a good planner on the deals that they can find. And I'll just help them get the deal done by funding it and taking a piece of the upside.
Yeah, excellent. So just really bringing this to a conclusion then, one of the, again, huge benefits I think the property crowdfunding offers people, entry level for as low as £100. And I know I've used this example before, I'm going to use it again. My own son, Joshua, is 21 years old, currently on a year out from his business studies degree. He's actually working with us as an intern for the year, which is quite cool. But he was driving for Argos as a part-time job, Domino's Pizza's part-time job, making his money to pay for his car. So we're in that stage of life, I'm sure many people are. But already he has invested in 3 deals on crowdfunding platforms. Now, a small amount of money, but he's now building up assets, and that as the years go by, if he keeps that up, then it's a great way of starting on the property ladder and the property journey. And it may be sometime in the future he can use that for a deposit on a house, for instance. So the entry level, I think, is really exciting and allows for people even just to learn, John, to understand better about property.
So David, before you ever had a crowdfunding platform, I'm the guy who created the need for £100 offers. So I was in a different conversation for other people raising money, and I said to them, look, what's more or less the entry price for a course? Maybe a half-day course or whatever. This is back when you could meet in person. And we sort of agreed that it was about £97. After the course is over, maybe you've got a few business cards because you're still networking, learned a few things, you had to travel in and out to a hotel or something, but you still haven't started. Here, you can actually learn about topics you want to learn about, planning, whatever it is, HMO, and you're an investor, and you might actually turn a profit. So if you turn a profit for the same £100 that you would have spent in a course, you got to be further ahead. And emotionally, people tend to pay more attention when they're investing in something than when they're just sitting in a classroom. So this is a way to do things rather than just passively listen to the guru at the front upsell you to a more expensive course.
Yeah, absolutely. And I think one of the lead-ons from that, a topic for another day. Things like auto invest, where if someone has decided what disposable income they have that they wish to invest in assets, and obviously it's different for everybody. For some people it's £100, some might be 1,000, some might be 10,000. But if the strategy is just to regularly keep investing that in multiple deals on crowdfunding platforms, then that's a very interesting strategy. The discipline of investing every month or on a regular basis. Again, you're into compounding, you're into all the other sort of good things that happen within the world of property assets, and the whole learn while you earn is great. So invest small until you're comfortable, and as you get more comfortable with the process, more comfortable with this type of investing, then you can choose to go up. And again, go ahead.
I would stay away from auto invest, particularly on peer-to-peer platforms. You're not learning squat because you're not even making a decision. You're not reviewing anything. You're basically blindly having a robot do it for you. And I think it's learn, earn, own. So being a lender is not owning anything other than you own a piece of the loan. Big deal. It's like having a savings account. How much did you learn about investing by having a savings account? So learn, earn, own. Be the owner. Be in JVs that are legally set up correctly. Skip this auto invest crap.
Yeah, well, I 100% agree with what you're saying. It was more the mindset of auto invest, as in putting a little bit of money away regularly into the asset. And of course, it's better on we would argue it's
discipline in making decisions.
That auto invest mindset as a strategy, as opposed to, as you say, that there's no point in just lending. You want to actually own the asset, which is what this is all about. So, but yeah, the fact that we've even had that discussion of bouncing ideas shows people there are things that need to be learned. There are things that need to be understood about investing in assets, investing in crowdfunding platforms. So learn, invest in a few deals, understand them, and then decide what's best for you as a strategy. Now, of course, as the caveat over all of this, capital is at risk. Returns are not guaranteed. And again, I want to make that obviously very, very clear. And John and I are not giving any financial advice. We're not IFAs. We're simply throwing in a bit of our experience from property and wider asset classes. So again, just to highlight that as a summary. So again, as we wrap up today, anyone who wants to reach out to John and I, you can have a brief phone call with us. We do offer a consultancy where we work together with clients, helping them to achieve what they want to achieve, or to help solve a problem that they may well have. And certainly that may involve using a crowdfunding platform to raise funds, or perhaps not. But we're certainly available for those conversations. You can screen grab what's on there now, or take a quick video of it. And that brings us to the end of today again. So I had hoped to be able to announce our next speaker next week, but he's actually not, he wasn't able to get a hold of him this morning. But we do plan to have a guest speaker next week. And we'll obviously hear about that as soon as we have it confirmed through the normal social media and through our weekly update. So that's all from me, John, today. Any last minute comments?
Just there's a person who said that they like the new update format for being an investor in the Nuneaton project. So well done to the team that created the new format, and thanks everybody for those improvements, because it does read a lot easier and makes it, I can learn more and pay attention to the project quickly. So
yeah, that's interesting. Actually, maybe next week as one of the quick updates, we'll show people that and explain why we've done it and that again. So thank you for the feedback for the person that gave us that. So okay, everyone, listen, thank you very much for your time again today. Hope again today was beneficial, and wish you every success with the rest of the day and the rest of the week. And talk to you again next week. Au revoir. Bye-bye.
Bye-bye.